12 days ago, China locked the vault, not figuratively, not as a policy signal. On January 1st, 2026, Beijing implemented export licensing requirements that ring-fence 65% of the world as refined silver supply for domestic use, overnight. The licensing framework demands exporters produce at least 80 tons annually and maintain $30 million in credit lines, thresholds that eliminate virtually every small and mid-sized refiner from international markets. This is not speculation. This is not a forecast built on hope. This happened. And here's what almost no one is talking about. The silver didn't leave. It stayed. 230 million ounces. That's the deficit the global market ran in 2025 alone. Not over a decade. In 1 year. And now the country that refines more silver than anyone else on Earth has decided that metal isn't going anywhere. But here's why this matters to you specifically, and why you need to watch this to the end. There's a number, a ratio, that institutional desks monitor religiously. And when it crosses a certain threshold, it triggers a cascade that most retail investors won't see coming until it's already repriced to the market. I'm going to show you that number. I'm going to explain exactly what it means. And I'm going to tell you where it sits right now. What I'm about to walk you through isn't a price prediction. It's a breakdown of market plumbing, the pipes that move silver from mine to manufacturer, from vault to end user. And right now, those pipes are cracking under pressure that most people can't even see. I'll show you why the price on your screen, the futures price, the spot price, everyone quotes, is diverging from physical reality by as much as $50 per ounce. I'll explain how exchange inventories have collapsed by 70% since 2020, why lease rates spiked to 200% annualized, and what happens when the core assumption underlying the entire silver market can no longer hold. By the end of this, you'll understand why $100 per ounce isn't optimistic. It's arithmetic. If this is the kind of analysis that cuts through noise and shows you what's actually happening beneath the surface, the mechanics that move markets before headlines catch up, consider subscribing. This channel exists for people who want to understand the structure, not just the story. Let's begin. I've been watching commodity flows for a long time, tracking warehouse receipts, monitoring open interest ratios, reading settlement reports that never make headlines. And one of the things you learn in this space is that markets don't break all at once. They break in sequence. One assumption fails, then the next one absorbs the stress, then that one fails too. And by the time the headline hits, the damage is already done. Let me explain something that matters here. The difference between registered and eligible inventory. On the COMEX, that's the primary futures exchange for silver in the United States, there are two categories of metal sitting in approved warehouses. Eligible silver meets the exchange's quality specifications, but isn't immediately available for delivery. Registered silver is the metal that can actually be delivered against a futures contract. Think of it like this. Eligible silver is like money in a safety deposit box. It exists, it's real, but it's not yours to spend. Registered silver is the cash in the till. When someone shows up demanding physical delivery, that's what gets handed over. Now here's the critical point. At the start of 2020, COMEX had roughly 346 million ounces of registered silver. By late 2025, that number had collapsed to under 127 million ounces, a decline of more than 60%. And in December alone, just December, approximately 65 million ounces were requested for physical delivery. That's more than half the remaining registered inventory in a single month. The exchange couldn't fulfill those requests with metal. An estimated 95% had to settle in cash. This is where the math breaks. Let me walk you through how the silver market is supposed to work. Because understanding the normal operation is the only way to see why the current situation is so dangerous. Silver trades on futures exchanges. A futures contract is essentially a promise. I agree to deliver a specific quantity of metal at a specific date in the future, at a price we lock in today. Most of these contracts never result in actual delivery. Traders close their positions before expiration. The exchange functions as an intermediary, a clearinghouse that ensures both sides of the trade are honored. The system depends on one critical assumption, that if someone does demand delivery, the metal will be there. That assumption has worked for decades because the ratio of paper contracts to physical metal stayed within manageable bounds. There was always enough registered inventory to satisfy the small percentage of traders who wanted actual metal instead of cash settlement. But here's the first layer of risk. That ratio has inverted. Open interest, the total number of outstanding contracts, now vastly exceeds the physical inventory backing it. We're not talking about 2-to-1 or 3-to-1 leverage. At points in 2025, the ratio of paper claims to deliverable silver exceeded 40-to-1. 40 promises for every ounce of metal available. Now, as long as most traders don't demand delivery, this works. The system functions on the assumption that the vast majority will always take cash instead of metal. It's the same principle that allows banks to operate with fractional reserves. Not everyone will withdraw at once. But what happens when that assumption fails? The second layer is supply inelasticity. Silver is not like oil. You can't just drill more wells. Approximately 75 to 80% of global silver production comes as a byproduct of mining other metals: copper, zinc, lead. The economics of those operations are driven by the base metal, not the silver. This means that even when silver prices double, mine supply doesn't respond proportionally. If copper prices are weak, miners reduce output regardless of what silver is doing. The silver simply doesn't get produced. Primary silver mines, operations that specifically target silver as their main output, represent only about 25% of global supply. And developing a new mine takes 8 to 12 years from discovery to production. Even if prices signal a need for more supply, the market can't deliver it in any reasonable time frame. In 2025, global mine production hovered around 830 million ounces. Recycling added approximately 150 million. Total supply, roughly 1 billion ounces. Total demand exceeded 1.2 billion ounces. That's a structural deficit of 230 million ounces in a single year. The fifth consecutive year of deficit. Cumulative shortfall since 2021, over 800 million ounces. This metal isn't being replenished. It's being consumed, literally consumed, in solar panels, in electronics, in photovoltaic cells that get installed on rooftops and never return to the market. Unlike gold, which accumulates in vaults and jewelry boxes, industrial silver disappears. Here's the third layer: geographic concentration. China refines more silver than any other country. China manufactures more solar panels than anyone else. And China has just told the world that its domestic needs come first. The January 2026 export licensing requirements aren't a ban, they're a valve. Beijing can tighten or loosen the flow depending on geopolitical circumstances. Today it's strict licensing. Tomorrow it could be reduced quotas. The month after, it could be a complete prohibition. We've seen this before with rare earth elements. China controlled the supply chain, gradually restricted exports, and by the time Western manufacturers scrambled for alternatives, years had passed. The pricing power had already shifted. Silver is now entering the same strategic category. It's not just a precious metal anymore, it's a critical mineral for the energy transition. Every solar panel needs silver. Every electric vehicle uses 2 to 3 times more silver than a traditional car. Every data center running AI workloads requires silver-intensive components. And the country that controls the refining has decided to prioritize its own consumption. The fourth layer, and this is where it gets technical, is the divergence between paper and physical markets. On the COMEX, silver futures were trading in the low $30 range through much of late 2025. Standard price quotes. Business as usual. But in Shanghai, physical silver was trading above $80 per ounce. Read that again. A $50 gap between the futures price in New York and the physical price in China. This isn't a rounding error. This is a structural disconnect between what the paper market says silver is worth and what actual buyers are willing to pay to get their hands on real metal. The Shanghai premium reflects desperation. Manufacturers who need silver for production can't rely on paper contracts that might settle in cash. They need metal, and they're paying whatever it takes to secure it. When lease rates, the cost of borrowing physical silver, spike to 200% annualized, that tells you something. It tells you that metal is so scarce that borrowers will pay extraordinary premiums just to access it temporarily. Under normal conditions, lease rates hover around 0.5%. The spread between normal and crisis isn't a gradual incline, it's a cliff. Let me walk you through a scenario. This is the kind of stress test that risk managers run, though few ever publish the results. Start with a baseline. COMEX has 127 million ounces of registered silver. Open interest represents claims on significantly more metal than that. As long as delivery demands stay low, say 5 to 10% of expiring contracts, the system can handle it. Cash settlement covers the rest. Now introduce a shock. China's export controls tighten further. Shanghai inventories, already at decade lows, drop another 30%. London's LBMA vaults, which have lost 40% of their holdings since 2021, face another wave of withdrawals, as industrial users scramble to secure physical supply. Suddenly, delivery demands on COMEX spike. Not 10%, 30%, 40%. The math doesn't work. There isn't enough registered metal to cover those requests. The exchange has 3 options. First, halt trading. Second, force cash settlement at the current paper price, which means telling contract holders they can't get the metal they were promised. Third, let the price adjust until delivery demand falls back to manageable levels. Option 3 is the only sustainable path. But that adjustment isn't gradual. When paper promises collide with physical scarcity, the price doesn't creep up. It gaps. Think of it like a crowded theater with one exit. As long as everyone walks calmly, the door handles the flow. But if someone yells fire, the math changes instantly. The door becomes a bottleneck. People pile up. The orderly process breaks down. Silver markets are approaching that moment. The exit door, physical delivery, is too small for the crowd trying to use it. Now, let me explain why confidence collapse accelerates nonlinearly. In normal markets, price moves create their own feedback loops. Price goes up, marginal sellers appear, supply increases, price stabilizes. This works when supply can respond. But when supply is inelastic, when there's no more metal to bring to market regardless of price, the feedback loop reverses. Price goes up, no new supply appears. Buyers become more aggressive because they fear scarcity. Price goes up faster, still no supply. Panic sets in. The dam doesn't crack slowly and give you time to evacuate. It holds until it doesn't. Then the whole structure fails at once. We saw a preview of this in late 2025 when silver lease rates spiked and COMEX inventories collapsed. The exchange reportedly halted trading briefly during the December rally, citing cooling system failures, perhaps. Or perhaps the infrastructure stress was more fundamental than anyone wanted to admit. The point is that these systems are designed for normal conditions. They're not designed for a world where the largest refiner has closed its export valve, where 5 consecutive years of deficits have drained global inventories, where industrial demand is structurally inelastic because you can't build solar panels without silver. So where does this lead? Let me give you 3 scenarios. The first scenario is fantasy. Supply magically appears. New mines come online years ahead of schedule. Recycling rates triple. China reverses course and floods the market with exports. Paper and physical prices converge at current levels. Everyone exhales. Probability, near zero. The geology doesn't support it. The politics don't support it. The economics don't support it. The second scenario is disorderly failure. COMEX formally defaults on physical delivery obligations. Futures contracts become meaningless paper. Price discovery shifts entirely to physical markets, which are opaque, fragmented, and illiquid. Industrial users face genuine shortages that disrupt manufacturing. Trust in the exchange system collapses. This isn't impossible, but it would inflict severe damage on the broader financial infrastructure that depends on commodity exchanges functioning normally. Probability, 10 to 15%, higher if geopolitical tensions escalate. The third scenario, and this is the path we're currently on, is managed repricing. The paper price gradually adjusts upward to close the gap with physical reality. Exchanges raise margin requirements to cool speculative excess. Industrial users lock in long-term supply contracts directly with miners. Bypassing the exchange system, prices reach triple digits, $100 perhaps higher, over the next 12 to 18 months. This is painful, but it's orderly. The system survives, even if the price level shocks participants who haven't been paying attention. Probability, 70 to 75%. Here's what this means for you. Do not panic. Panic is not a strategy. Understanding is a strategy. The transition from $30 silver to $100 silver isn't a single event. It's a process with observable signposts, measurable indicators, and predictable phases. If you understand the mechanics, you can position accordingly. The strategic question isn't whether to own silver. It's how much, in what form, and with what time horizon. Physical ownership, bars, coins, allocated metal in a secure vault, removes counterparty risk. You're not dependent on an exchange's ability to deliver. You're not exposed to cash settlement at prices that don't reflect reality. You hold the metal. But physical comes with its own considerations. Storage, insurance, liquidity. These aren't trivial. Paper exposure, ETFs, futures, mining shares, offers convenience and liquidity, but carries the risks we've been discussing. In a crisis, paper promises may not be honored at expected values. The answer isn't binary. A thoughtful allocation considers both. Here's what to watch. First, monitor the spread between Shanghai physical prices and COMEX futures. A sustained premium above $20 indicates persistent physical tightness. Above $50 signals crisis-level dislocation. Second, track COMEX registered inventory. Weekly reports from the CME show exactly how much deliverable metal sits in approved warehouses. Every draw below 100 million ounces increases systemic stress. Third, watch lease rates. The 1-month silver lease rate is available from several data providers. Anything above 10% annualized signals acute physical scarcity. Above 50% indicates emergency conditions. Fourth, observe exchange margin requirements. When COMEX raises initial margin, the cash required to hold a futures position, that's the exchange trying to reduce speculative leverage before it becomes dangerous. Multiple margin hikes in rapid succession indicate the exchange is worried about delivery failure. Fifth, pay attention to China's export data. Monthly silver export figures from Chinese customs reveal how much metal is actually leaving the country. A sustained drop below historical averages confirms the export controls are binding. These aren't predictions, they're measurements. Check them weekly. Let the data inform your assessment. Now let me zoom out. Because this isn't just about silver. We're living through a structural shift in how commodity markets function. For decades, financial markets, paper markets, dominated price discovery. Futures exchanges in New York and London set global prices. Physical markets followed. That relationship is inverting. In silver, in copper, in rare earths, in lithium, wherever supply chains are constrained and demand is inelastic, physical scarcity is wresting control of price discovery away from paper markets. This matters beyond any single commodity. It represents a fundamental change in the architecture of global trade. Countries with physical resources are asserting sovereignty over those resources. The assumption that anything can be bought at any time at market prices, that liquidity is infinite, no longer holds. The countries that manufacture things need materials. The countries that have materials increasingly want to keep them or extract maximum leverage for selling them. The friction between these two forces is repricing everything. Silver is simply one of the most visible examples because the market is relatively small. The supply constraints are severe, and the industrial applications are critical to technologies everyone is counting on for the future. Let me leave you with this. The question is not if silver reaches $100. The arithmetic is already in motion. Deficits compound. Inventories deplete. Industrial demand doesn't negotiate. The question is not whether China's export controls matter. They matter. The metal stays where Beijing decides it stays. The question is not whether paper markets will adjust. They will adjust, or they will break. The only question is how long. How long until the gap between paper and physical becomes undeniable? How long until the institutions that have been arbitraging this discrepancy exhaust their ability to manage it? How long until the price you see on a screen reflects the price buyers actually pay to take possession? My assessment: we're measuring this in months, not years. The thesis isn't complicated. It's supply and demand, filtered through market structure and geopolitical constraint. The world needs silver. The world doesn't have enough. And the largest source just closed the door. Let me leave you with this. The question is not if silver reaches $100. The arithmetic is already in motion. Deficits compound. Inventories deplete. Industrial demand doesn't negotiate. The question is not whether China's export controls matter. They matter. The metal stays where Beijing decides it stays. The question is not whether paper markets will adjust. They will adjust, or they will break. The only question is how long. How long until the gap between paper and physical becomes undeniable? How long until the institutions that have been arbitraging this discrepancy exhaust their ability to manage it? How long until the price you see on a screen reflects the price buyers actually pay to take possession? My assessment: we're measuring this in months, not years. The thesis isn't complicated. Supply and demand, filtered through market structure and geopolitical constraint. The world needs silver. The world doesn't have enough. And the largest source just closed the door. That's not theory. That's position. Now here's what I want you to do. First, if you found this analysis valuable, if it showed you something you hadn't seen elsewhere, hit subscribe. Not because I'm asking, but because what's unfolding in silver is one chapter of a larger story. The same mechanics, physical scarcity, supply chain fragmentation, the inversion of paper and real markets are playing out across copper, rare earths, uranium, and critical minerals that underpin the entire energy transition. I'm going to cover all of it, and if you're not subscribed, you'll miss the next signal before it becomes a headline. Second, share this video with one person who needs to see it. Someone who holds paper assets and assumes liquidity is infinite. Someone who thinks commodity markets are boring. Someone who doesn't realize that the architecture of global trade is shifting beneath their feet. Send it to them. Because understanding these mechanics 6 months early is worth more than reacting 6 months late. Third, drop a comment below. Tell me what you're watching. What signals are you tracking? What questions do you have about the physical markets? I read every comment, and the best questions become future videos. The window to understand this is now. The window to position accordingly is narrowing. Stay informed, stay patient, and recognize that the time to understand these mechanics was before they mattered. Now they matter. I'll see you in the next one.